All right, well, let's get started. Good morning, everyone. Thanks for coming. My name's Ron Hoppy. Name of my company is Main Street Associates. What I'm hoping to do today is provide you with some very pertinent information that may help you close more sales, get more commissions. We're going to be discussing and make you, I hope, a little more comfortable with seller financing and real estate paper. I would like to just spend a very short time kind of telling you about our company so you know why we think we're qualified to sit up here and talk about this and why you got up early and came down here. I'm a California licensed real estate broker. I also have an NMLS endorsement, and I'm also a general contractor. And we have done just about every kind of real estate transaction possible over the course since about 1985. And in the current situation and in the past several years, we've become almost 100% trust deed investors. We invest in trust deeds in primarily 4 different ways. The first, and the one that I'm hoping to convey some information to you today to help you, is we do a lot of purchasing of seller financed mortgages at the closing table. So we allow the seller to get cash with a buyer that maybe can't get conventional financing. In addition to that, there are sellers who don't want to get conventional financing. They want to carry the paper. It's a form of retirement income or whatever. So that's one area that we perform in. The second area is that we buy existing notes from note holders who either were seller financiers at the start and now want cash for their note, or they bought a note at some period of time and now want to cash out on it. The third way is that we are private lenders. We loan to real estate investors on non-owner occupied rehabs. So if you have investors that are looking for money to buy and rehab their properties, we do trust deeds there. That's usually short-term, 6 months to a year. And then the biggest part of our business, but not necessarily the important part to you, is that we buy from lenders their tapes of non-performing notes. And then we get them re-performing and sell them out to real estate investors or trust deed investors or institutional investors. So basically that's what we do. We've become pretty knowledgeable about real estate finance. And you're going to hear me say seller financing and owner financing a lot, and really that's not what we're talking about. What we're talking about is owner or seller installment sales. And there's a difference. The common nomenclature is seller finance or owner finance, but finance in the real estate world and in the legal world means that money changes hands. In owner financing and owner installment sales, the owner doesn't actually loan money. They trade their equity for payments. And there's an important distinction there legally, because there's a lot of regulations and laws that come along with loaning money that don't apply to owner installment sales. However, we like to perform in an arena where we do what's required of lenders so that we don't ever have any problems down the road. So, but when I say seller financing in this environment, we're talking about owner installment sales. Okay? A couple of things that we're going to need to know about. The first is you're going to have to know how to use a financial calculator. I assume everybody does, or they have one. The ones that we use are either HP 12C, 10B2, and both of them are available on your smartphone for $5.99. I think this right now is about 90 bucks. This one might be 35. This is $5.99. My problem with this one is old eyes. It's pretty small. So, but you are going to have to be able to do calculations with a financial calculator in order to determine note value, amortization payments, and so on. But there's really only 5 keys on any of those that you need. The first is N. That's the number of payments. The only difference between this one and this one is this one calculates in years and this one calculates in months. So if you're going to do a 30-year amortization, you have to put in 30 and use a G factor to get 360 months. This one does it automatically. The other one is interest, present value, payment, and future value. All right? So we're going to have to know how to use those keys. And for anything that we do with notes, you can, by knowing what to do with these 5 buttons, you can calculate anything you need to know about a value of a note or a payment or what the present value is and so on. So one other thing I think you'll see passed out at your desk is this investor questionnaire. This is a brand new law. Came about in the first of the year. It has to do with selling a note and a requirement for the seller to get an investor questionnaire filled out on the person buying the note, because our government, of course, wants to protect people that are buying a note, making sure that they're sophisticated enough to be doing that. So that's a new requirement. Once a year, if you're selling notes, you need to get that filled out by your investors. All right? So I'd like to quickly introduce the people that came with me today that work with me. First is Tyler. Tyler happens to be my son. Tyler's a California licensed attorney. He's a partner at Hoppy Reed PC. He primarily concentrates on real estate law. He'll be happy to answer any questions, not necessarily on trust or on loans and notes today. Whatever, if you have questions, please ask him. His partner, Thomas Reed, concentrates primarily on estate and estate planning. Chrissy Jones is our CFO. She is my daughter, and she actually works for our company. Tyler has his own firm. And then Mark is our IT guy, and then we have some people back in the office today that are still keeping the place running. So, Larry Canfield he runs our pricing desk. So when we buy notes, either from private owners or from lenders, Larry's the guy who figures out how much we can pay for them. So again, thank you guys for coming. I do hope that by the time you leave here this morning, you'll have a better understanding of the note business, and maybe will have been helpful in you getting more listings and more sales. That's the name of the game. Okay, Tyler. So really, most real estate agents don't really know or understand the power of seller financing. Or if they do know about seller financing, they're afraid of it because of the litigation that might be involved in it. Even those that do, we're sorry, we have a kind of an issue because the computer we're going to use doesn't work here. So Tyler and I are trying to communicate about when to change this slide. And then even the agents who do know or have used seller financing Rarely do they tell their clients about the ability of a client to sell their note in the open market. And that's where today I think will be important for you, because we're going to be able to show you how you can get involved in getting a seller financed, a deal put together, and then allowing the note holder, the seller of the property, to sell that right at the close if that's the desire. Okay, next. So there are some huge benefits to seller financing for the agent. The first being is you can increase your number of listings, because some of the problems, we all know that today is a very challenging time to be a real estate agent. You find a buyer, you find a seller, and you can't find a lender. And a lot of times it's due to either the strength of the borrower or the property. You might be able to take listings that you normally might not want to take because you know that you can get it financed, where before you use seller financing you might not have been able to. You can increase the number of escrows that you close. You can save lost sales due to the buyer not qualifying. Increase your potential of buyers. They lead to faster closing. I've closed deals in as little as 3 days. 5 days is not uncommon, and 7 days would be usual. So you're not waiting for a bank to make a decision. You're not waiting for an appraiser to get out there and appraise it and get the appraisal back to you. You're not fighting with the appraiser to say they came in low or whatever. It's just a lot faster transaction. You can earn more commissions, of course, and you can build a significant referral base. So what's the market like today? Well, owner financing is up 40% in 2012 over 2011. And it's expected to increase even more in 2013 over 2012. Today, and I'm sure you have realized this, only 2 of 5 borrowers who qualified for FHA financing in 2006 qualify today. Only 40% of the people who qualified in 2006 qualify today for the same loan. In some markets, less than 50% of deserving buyers, not flakes, deserving buyers, are not qualifying for conventional funding. Have you guys seen that? Has that been a problem for you? Well, we can solve that today. 30% of all properties are owned free and clear. They make great candidates for seller financing. Others can be done with a wrap, or better yet, a land trust. And so we've all been there. We have a willing buyer, we have a willing seller, but we can't find a willing lender. So we're going to address it with the seller of the property. Okay? This is a pretty good indication and slide to show how many more potential buyers. This is a pretty accurate percentage here. You can get about, you can get more than 50% more buyers, up to 60% more buyers if you offer seller financing than if you are not offering seller financing. So you'll get 60% more potential buyers looking at your property. Okay. Up to 1/2 of all your listings may be candidates for owner financing. 1/3 of all properties, like I said, are owned free and clear, and the others we can do a wrap. Everybody knows what a wrap is, I think. Or we can use a land trust. Not everybody is familiar with a land trust, and that's something that we use it all the time. We probably need to do some education on it, or Tyler does, about what a land trust is and how it's used in purchasing real estate and avoiding a due on sale clause that typically happens when somebody buys a house subject to. So some of the reasons for the impossibility of getting financed are: 1, Self-employed. I don't care if you're a lawyer, a dentist, a doctor, a real estate agent, whatever. It's difficult to get self-employed people financed. Stated incomes are a thing of the past. I just had a client a couple weeks ago that is an extremely successful real estate investor, owns multiple multi-unit properties, got turned down for a mortgage, and nobody would take the loan. Those within short employment histories, and there are a lot of those today, where people have lost their jobs. We've had people that have lost their jobs that now are working again. They have a better job today, making more money than they made before, but they have a short employment history, and they cannot get financed. Maybe they have less than 20% down. 20% in our world is ideal. It happens rarely. They might have a previous short sale or a previous foreclosure in the recent past, and they cannot get financed. Or it might be a non-conventional property. I'm going to show you one of those in just a minute. Or it could be a jumbo. All those reasons for not getting financing are present today, makes our job a lot more challenging. So let me show you what happens when a real estate agent is not knowledgeable or is afraid of seller financing. In this case, the property asking price was $900,000. The buyer had a down payment of $300,000. The buyer had left a house worth $1.8 million. The proposal was the buyer would put $300,000 down, and the seller would carry a first for $600,000. We would purchase the loan immediately at the close for $475,000, making the cash to the seller $775,000. The agent's commission on this deal would have been, it was a 5% commission, would have been $45,000, 5% of $900,000. The agent, the listing agent that represented the seller, would not allow her client and advised against them doing it because of the hocus pocus of seller financing. So what actually happened? Well, the asking price of $900,000, they waited long enough and finally got a cash offer. Cash offer was for $600,000. The agent advised the seller to take it. The seller got $600,000 at the close, and the commission at 5% was $30,000. So who won on that deal? Certainly not the homeowner, certainly not the agent. The cash buyer won, but had the seller been advised and had the agent known the strength of seller financing, there could have been $175,000 more on the table for a house that was valued at $900,000. Okay? So the reason that people are afraid or they don't use seller financing is because of some myths that exist in the marketplace. The first being that only desperate sellers carry paper. Now, there are desperate sellers that carry paper. There are desperate sellers that carry paper that are stuck with it because they've put the deal together poorly and there's no market for it after the sale. But believe me, there are many, many, many owner finance sales because the owner wanted it to be an owner finance sale. Especially people that are retired, that are selling real estate and using the payments as a retirement income. So the second, there's a lot of hocus pocus. You can't trust seller financing. Well, that may have been true many, many years ago, but today there's so many regulations that just isn't true. Seller financing is just as secure as lender financing. Seller financing is risky for my client. A properly structured owner-financed real estate deal is one of the most secure investments you can make. One of the big reasons for that is that in our underwriting, our clients, 65 to 70% of market value is the most that we'll allow our client to get involved with. So on a 70% deal on that $900,000 house, 630 would have been a 70%. That's the most that we would have allowed our client to take a note for. If the worst happened and they didn't get paid, they could sell it for a huge discount and still not lose money. And that's the key. You got to make them secure. You got to make them attractive. Yeah.
With that, I'm trying to think of the scenario how that example came up. Do you work with the seller to figure out, you know, the asking price? I mean, are you in the process from the very beginning?
Okay. We can't be here selling and promoting our company, but what we do is we assist. I don't broker any properties whatsoever, but I don't buy or sell representing clients. But what we do is help real estate agents or owners seller finance, and then we buy the loan at the closing table. That's what we do. So anybody in the room here that has a client that wants to sell their note, they have two choices. They can do it themselves and bring us in to buy it, or they can get us involved and we will make sure through an attorney that all the documents are correct, and that'll be closed through an escrow company just like every other transaction is done. But then the fear that a lot of people have of the transaction goes away because there's somebody else involved in putting it together. All right? Yeah.
Well, kind of piggybacking on her question, it's like when you're talking about you don't advise your clients, your financing clients to finance more than 70% of value and there's no appraisal, do you rely on the brokers to bring you comps? How do you determine fair market?
Yeah, well, we'll get a BPO probably, or depending on the $900,000 one, there'd have been an appraisal done on that. All right. Sometimes there are appraisals, but they're not required most of the time. That's why it can be so fast. Now I can call an appraiser that we use and say, I need an appraisal tomorrow, and we'll have an appraisal tomorrow. Yeah.
Well, certainly the buyer can bring their appraiser if the buyer wants the owner financing and they're going to commit themselves.
Oh, absolutely, right.
Then, you know, if I were a buyer's agent, I would say certainly go get your own appraisal. They're $400, $500. It's cheap relative to.
Yeah, what we do most of the time is we'll say to the buyer or to the borrower, meet an appraiser. You arrange to have an appraiser meet you at the property and you pay them right then. We don't want to get in a position where we're appraising and then deciding, okay, we're going to loan on that. One of the big caveats that you have here is the seller financing becomes so attractive to buyers that a tendency would be to charge more for the property. So let's say that a property is worth $200,000 market value, and we can find a buyer that the financing, and today this is very, very common, the financing dictates the value of the property, not the property. So we can go to somebody that can't buy a house that desperately wants one and say, yeah, we'll sell you this house for $240,000 and do seller financing. Well, that's usury, and you want to avoid that. You don't want, we encourage you to sell at the top of the market value. That's one of the big benefits of of owner financing is you can get top dollar for it, but you can't get more than the property is worth, right?
Can you just repeat what usury is considered? That's an interesting term when you're dealing with owner financing.
You know what? I'm going to let Tyler answer that later, okay? So write that down. And any of the legal questions, you can ask Tyler. But there is a usury problem that it's interpreted to be usury if you're charging more for the property to take advantage of a buyer because of seller financing. Yeah.
In the first example, the $900,000 house with the $600,000 note, it looks like the note was purchased at $475,000.
Right.
So that seems significantly discounted. I'm trying to understand why they wouldn't just reduce the price to $775,000
They did.
Sell it.
They did reduce the price.
I know they did.
Well,
prior to doing a cash offer. So I'm a little confused.
Okay.
So when they sell the note, they sell it at a discount?
We buy at a discount, certainly. That's what we do. That's how we make a profit. Okay. When these deals are done, there is no requirement to sell the note. All right, so the owner can keep the note. They can keep the note for 3 years and then sell it. But in this case, they were not getting, the first problem was they were not getting people financed. Well, they had plenty of buyers lined up, but nobody could get financed for it. All right. Secondly, they wanted some cash at the close. All right. Enough to make it worthwhile for them. $775 was worthwhile. They took $45 in closing costs off. And remember, this one didn't get done. But $475 is a pretty good price for it. Yeah.
So there are scenarios where it's a huge benefit for the seller if he needs cash right there, or if you just want higher interest rate over a long period of time.
That's right. And we'll cover that in a minute. Yeah, we're going to have to move on, and I'll take all the questions. I'll stay here all day if you'll write them down, but we'll take 2 more.
So you're buying a note. What is what's your protection from the buyer for the property defaulting on the note?
If the buyer defaults on the note, if I bought that $475, I have approximately $425,000 worth of equity to foreclose on. Now, the last thing we want to do is foreclose. Financially, the best thing we could have done was foreclose, all right, if that's the case, because that's the reason for the 65 to 70% loan to value. Now, the 65 to 70%, that's another thing that you need to keep in mind. There's 2 definitions that you need to be aware of if you're going to get involved in the note business. The first is LTV. Everybody knows what that means. Loan to value. Loan to value in our world is 65 to 70%. There is another term in our world, and that's called ITV. Investment to value. In this case, the loan to value was $600,000 divided by $900,000. Anybody do that real quick? Say, okay, so 66%. Now, if the seller of the house kept that property and the seller or the buyer defaulted on the note, he has 34% equity in that house to foreclose on and get it back and do the process again. But he has $300,000 cash in his pocket, all right? If we buy the note, and typically what we would do is we would buy this note, and at some period of time we're probably going to sell it. But our investment to value is not 600 divided by 900, it is 475 divided by 900. So 53%. Our investment to value is 53%. We put up $475,000 to purchase a $900,000 property. So if we buy the note and the buyer and the borrower, the person that bought the house, defaults, we have 47% protective equity. Or your investors that you sell the note to would have that kind of equity. These are two very important terms that you need to be aware of in the note investing business. So,
You still run credit on the buyer.
absolutely, we're going to cover that too. Yeah, yeah. So the other myth number 5. Seller financing means my client can't get cash at closing, and that means no commission. Well, we just...
Myth number 4, didn't go over that.
Oh, seller financing can only be used when a property is owned free and clear. That's a myth. We do wraps, we do land trusts, land contracts. There's a number of ways to sell a property that has a mortgage on it and still use seller financing for the gap.
Could you make an example? Give us an example of that?
Yeah. All right. Let's do a house. To keep the number simple for me, let's do a house that has a market value of $100,000, and it has a first on it today of $65,000. All right. So if we sell that house for $100,000, we have to either pay off this 65 or take it subject to. All right. So we're going to take it subject to. We're not going to pay it off. So what's going to happen here is, let's say the buyer comes in with $10,000 down payment. We're going to have a $90,000 loan that has to be made, and out of that loan, 65's got to be paid to the first lender. So what we'll do is write a $90,000 loan. It's going to be a second, and wrap this one here in with this one. So we collect on $90,000. The seller, and then we would be using a servicing company, which we'll cover in a little bit also. And then the servicing company would collect on the 90, they'd pay the 65 to the first, whatever the payment was on the 65 to the first, and they would send the remainder to us. That's a wrap. Okay, you're wrapping the second mortgage, you're wrapping the first inside a second mortgage. To avoid a due on sale clause, we would use a land trust for this. But I don't want to get into talking about land trust today, because it's a topic all of its own. But if you want to know more about it, we'd be happy to share it with you. In fact, I have some literature that we can send to you that kind of gives you an education on it. All right.
Can you just email that to us?
Sure. Yeah. Mm-hmm. We'll email it to everybody that we emailed the PowerPoint to. How's that?
Yeah.
Okay. All right. So, but that's the whole thing. And what's your name? What's your name?
Oh, Rico.
Rico. That's the thing that we're trying to get across, Rico, is that only free and clear houses are not the only candidates for seller finance. All right. That any property can be seller financed. Be difficult to do one and find an investor for a house that was upside down. But it could be done if somebody was willing to pay the payments and the investor was willing to put the money up. There's nothing legal stopping you from doing it. Okay, next. Okay, here's one that did work, and this is going to be one that you're going to question probably on the value. of the note, the property owner taking it, but this is asking price of $180,000. This happened to be a house that was converted to a daycare center. So the house didn't have any bedrooms. It had one bath that adults could use, and then another bath that had little tiny toilets and sinks and everything for the kids that came to daycare. So 3 people had made offers on this property. It could not be conventionally financed because it's not a residence, and it was in a residential area. It was permitted to be a daycare, but you couldn't sell it as a single-family resident, and no lender conventionally would lend on it. So what happened was, this house was on the market for 24 months. When a buyer came in and said, well, the 3 buyers previous to this had all tried to get SBA financing on it because it was going to be a daycare. So they thought they could get SBA financing. I knew they couldn't. So the 4th person that came in offered $50,000 down, or $40,000 down with a $140,000 seller carry first. And we immediately buy the note for $90,551. This happened to be owned by heirs. There was a death. Heirs own the property. Heirs are out of town. Daycare is shut down. There's nothing going on with the property, sitting there vacant. And so at the end, the seller gets $130,000 cash. That's a significant discount. But the house was sitting there deteriorating, and finally somebody qualifies now to buy it, and somebody steps up to the plate to finance the deal. So here's the case where the reason for the seller finance was a non-conforming property. All right? So the players in this game are the buyer, the seller, and the investor. And there can be, in the investment area, there can be the active investor, and there can be the passive investor. So of course we all know who the seller and the buyers are. That's who we represent in a transaction. We need to be astute enough to advise them on which direction to go to get the most out of the sale of their property. And as important today, how to get as much as they can for the note if they want to sell it at some later date. The active investor, that's us. We actively get involved in the transaction. We actually help the real estate agent put the deal together. We actually get involved in the documents. We get involved in the close. We direct the transaction from the financing point of view, not from we don't try to do your job. We try to do the job of the lender. We're a lot better at it than they are, by the way. And then there's the passive investor. There's the people that come to us and buy that note from us, or they're investors in our company. And they get a check every month, mailbox money. So one of the ways that one of the things that would happen is that we buy a note. Likely we would get one payment. The first payment we would get just to get everything solidified. We then would get it to a servicer. And everybody know what a servicer is? We're going to talk about servicers in a little bit. But we then give it to a servicer. They charge us, depending upon which one we use, $15 to $17 a month. And then we will sell the note to a passive investor if we don't keep it. This passive investor just buys the note from us. We tell the servicer, stop sending the check to us, start sending it to John Doe. Very passive. He gets mailbox money every month and doesn't worry about the note whatsoever. All right, it's just passive, good yield income. So we're the active investor. The people that invest with us or buy notes from us are the passive investors. Now, we've talked about what the benefits are of the real estate agent, but more importantly, and really the fiduciary that you have, is to tell your clients what are the benefits for them. And there are a lot. First, the installment sale can defer any capital gains. Now, this could be a rental property that is going to be owner financed. Or it could be one that the seller has eaten up their $500,000 tax and they need to pay capital gains. On an installment sale, they're only going to be paying capital gains tax as the installments come in. So the equity they have in the property, they're earning that interest on month after month, where if they sold it outright and got cash, the tax is going to be on the entire amount of cash. Let's say it's $100,000. They have to pay a capital gains tax, and today it's outrageous. So let's say that they end up with $70,000 after paying capital gains. They're going to have $70,000 to reinvest. Let's say they reinvest at 10%. That's $7,000 a year, where if they would have been on an installment sale, and the installment sale was 9%, and believe me, it's hard to get 7% anywhere but in real estate today. If they sold it and got capital gains tax only on the installment, they'd have the whole $100,000 that they would be earning money on, and the principal part goes down very slowly. We'll see that too. So there's a big benefit to them if they have a tax problem or if they want income. All right. The note security is the property they're selling, and the seller knows it like nobody else. They should be very secure in the property that they're selling, because it very well could have been the one they lived in for 35 years, and they know the property. Trust deeds, when done correctly, are one of the safest investments available. Has anybody ever bought or sold a house whose value went to zero? Anybody buy any Enron stock? How many people have bought stock that have gone to zero? I have. That's the nice thing about these notes. The principal remains the same. If I write a note today for $65,000, the note stays at $65,000 less the little bit of principal that comes down each month. I'm not in a position to really worry about my property going to zero. Okay? Your clients can usually collect much more income than receiving rent. Easy to figure out. How much do you guys think? Let's say that a house is worth $200,000 in Sacramento. What would be the rental income that you could expect to get off of that property? $1,450, $1,500.
I would say it's going to depend on the square footage. There's a direct correlation between square footage.
Okay, let's say that this is 1,750 square feet. 1,500. Rent $1,500. All right. Chrissy, do you have your calculator? Can you figure out what the 30-year amortization on that note is? Let's say the interest rate is 8%. By the way, on seller financing, we rarely would write a note. We would not write a note for less than 7.5%. We go from 7.5 to 9.5. If a buyer can buy through conventional financing, they should be buying through conventional financing. Yeah?
You're not subject to usury?
No.
Okay.
Well, and 9.5 is not usurious anyway.
So you want to do 9%?
Yeah, 9%.
So you can charge whatever interest rate
Yeah.
Sweet.
It is, except that when we show you about underwriting, you have to be careful that the debt-to-income ratio that you're going to charge your borrower fits, because you can get into trouble if there's no way that you know going in they can't make the payment. So what do we got, Chris?
1610.
Huh?
1610.
1610. All right, so with the rent, the landlord, the owner of the property, also has taxes. Taxes on that's going to be $2,000, let's say $180 a month. They're going to have maintenance. Sometimes sewer and water probably. They're also going to have a management fee, whether they're doing it themselves or whether they're having somebody else do it. You got to charge a management fee. So as you can see, you don't have any toilets, termites, or tenants with a note. And no vacancy. If you do, what happens? You take it back, you resell it, you get another note, you get another down payment. The benefits of being a note holder are far superior than being a landlord. There's only one thing you don't get with the note: appreciation. So we haven't had much of that lately anyway. So. Okay, and then the installment sale is not just for free and clear properties. We've talked about that before. Seller financing has a long history of popularity. More than $94 billion of private real estate notes are created each year. Seller financing can be used to quickly and inexpensively sell property for full market value. Notes can be held in a trust and enhance the quality of an inheritance for future generations, much better than the actual property, because if you have heirs that live in Wyoming who inherit a house in Sacramento, they can't wait to get rid of it. If they inherit a note, the note pays just like any investment pays. They don't have to worry about the house. They don't have a tenant in there. So you can put notes in a trust, and it is a good way to pass to your heirs, pass your estate to your heirs. Notes are flexible and can be created in many ways, and I'm going to show you a few to basically impact the discount on the note. So when somebody said that $30,000 or that $50,000 discount, or the $40,000 discount, or the $300,000 discount, whatever is too high, we'll show you how we can alleviate some of that problem very easily. Notes can be sold at the point of the note creation, that is at the closing table. We can do a note right then or any time in the future. And notes can help sell non-conforming properties. Okay, Ty? The note holder can sell a portion of the note. This is the exciting part that we're going to get to in just a minute. And raise quick cash. If a buyer stops paying, the seller keeps everything and gets the property back. Notes are easily appraised, and notes can represent passive income when a servicer is used. Owner financing is a great tool to help sellers sell quickly for top dollar, and we'd like to be sure that they also can sell their note for top dollar. That's our responsibility. So go to the next slide. How many note buyers are there? Go to Google. Google note buyer. There's only 44,500,000 pages referring to note buyers on the internet. We're one of them. One of 44,500,000 pages. So I mean, if somebody just wanted to sell a note, they could find somebody to buy a note simply by going to Google. That's how big the market is. I wouldn't unless I knew who they were, but it's a huge marketplace. So what are we going to do to make sure that our buyer, or that our client, the seller of the house is doing the less risky business that's possible? Well, we're going to act just like any other lender. We're going to get a 1003, which is just the Fannie Mae application. We're going to get the Social Security number from the payer, the guy that's borrowing the money, and make sure that that Social Security number matches the Social Security number on the credit report that we're going to get. Now, we're not saying that credit is a must to have sterling credit, but we want to know what the credit report is because we want to verify employment. We want to see how long they've been there. We want to verify debt to income ratio to make sure that they can pay for the property or pay for the note that we're creating and so on. And if they have been renting in the past, we want to get a rental history. That's the things that we would be doing if we were involved with you. It's things that you need to do if you're not, if we're not. Yes?
I have a question. There's a lot of people out there that are short sale, they're gone through foreclosure, but they love being owners, they hate being renters.
So
if they have a reasonable credit report and secure job history and everything else, they're great candidates for these programs.
That's right, but here's what, that's exactly right, but here's what you need to do. You need to have this package put together so that your seller can look at it and make a decision based upon that information, because what you don't want to do is say, well, they had a short sale, but that's not a big deal. Because now if they default, guess where they're going to come? They're going to come right back to you. So what we do is we prepare a package and then we counsel the seller and say, here's what happened. You know, half the sales or more today are short sales. They ding your credit. If without the short sale, their credit rating would be here. That's one of the big benefits of seller financing is you can take people that do have dinged credit because of short sale foreclosure, and their credits may be very, very low. But right now, they're in a position to make the payments, and that's what we care about, yeah.
And is it that kind of instance where you keep the loan-to-value ratio at 65%?
Yeah, we're going to go through that. Yeah, exactly right. Up to half of all listings may be candidates for owner financing. We can structure the note and the sale of the property and the note to the satisfaction of both the buyer and the seller. One of the big things is we need to find out what the seller wants, what the seller needs, and what the buyer can do. And then we can structure a note and a sale around that. The note business provides a flexibility and a marketability unlike selling a house. Okay. So what determines the value of the note? Well, first is the qualification of the buyer, and we just qualified the buyer. So we might have a low qualified buyer, but a very nice collateralized loan, maybe a 50% loan to value. So the buyer qualifications is number one, the collateral is number two, and then the note itself. What's the down payment? What are the terms? The interest rate, how long the note's going to last? What is the seasoning? Seasoning, everybody knows probably, is just the history of the payments. Have they paid on time every time? Have they missed payments? Have they been late or whatever? That all goes into determining the value of a note. Okay. So here's our recommendations. Now these are not cast in stone. These are not. We will manipulate and maneuver these numbers depending upon a lot of issues, but here's our recommendation and our kind of underwriting guidelines. A credit score of 580 to 600, we want to get a 20% down payment. Now I'll be very honest, we rarely get a 20% down payment. 15% is common and 10 is usual. But 15 and 10 are based upon other factors other than their credit score. All right, there could be a case where there was a medical problem, the credit score went in the toilet. We just had one where the husband and wife were working. The husband lost his job. The wife could make payments on the first, could not make payments on the second. Second foreclosed, they lost their house. The husband was now back to work again, and their income supported the amount of money that the note was going to be on a new purchase. So just because their credit score was 547 didn't keep them from buying that house. From 600 to 625, our normal guidelines are 15% down, and 625 and above, 90%. We rarely do a deal where we don't get at least 10% down. Yeah.
How do you protect the collateral for the investor, you say in the event that the house gets foreclosed upon and the investor, the buyer, ends up, deciding to walk out with, decides he wants to destroy the place before he leaves?
Well, there's two things in this one. Number one is who's the buyer, who's the seller and who's the investor. If you are the listing agent and you're trying to protect your buyer, and your buyer takes a look at the package that you put together on this seller or this buyer. If your seller takes a look at the package and is not comfortable with the package, you don't sell the house to that guy. However, if we're involved, we got to go back here. All right, because when we sit down at the closing table, we are going to determine how much money we will pay for that note. And we're going to base it on the three areas, the buyer strength, the collateral strength, and then the other parts of the note and so on. So what happens with us is we don't buy at that 90% level. We're going to create investment to value for us. Your client, the seller, may prefer, like she said, to drop the price and get cash as opposed to taking the risk of the note. If we buy it, we're comfortable with that risk because we got a lot of room to maneuver. But on a 10% down, we want to be sure that we got a good buyer. All right? And if we found out, for example, that they were foreclosed on before and stripped all the copper and the air conditioner out of it, we would not take that note. All right? Okay, never exceed 90. We have, but I'll give you, yeah.
I was going to point out, it might be helpful to clarify that if there is no wrap, the seller's out of the picture if it's on investment.
Oh, if we buy it.
Correct.
Yeah.
Someone's buying the note.
Right, they're done.
They're done.
They're done.
The risk to them of foreclosure.
Yeah.
Only the note buyer has.
Only the note buyer has the risk of foreclosure, but if they keep the note, they have that problem. Then they'll be calling some attorney and foreclosing. Give you an idea. We buy non-performing notes primarily. As far as the bulk of our business, the dollar amount. We buy non-performing notes and get them reperforming, and the interesting thing is that we only have to actually foreclose on about 8%, and we buy the note when it's defaulted. And in many cases, probably more than half the cases, the property's worth less than it was, or less than the loan that's on it. So most people want to stay in the house. So, foreclosure is something that you have to worry about for your client because you have a duty to do so. But in these cases, we're not giving them a mirror test and say, hey, fog this mirror up and we'll give you a loan like they did in 2005. We're being pretty cautious and conservative for our homeowner.
If you are a seller and you want to do the installment sales and keep it, you would approach an attorney to help you set that up, is that right? Or would you do that for, I mean, if the seller doesn't, and I don't know how to do it as their agent.
Do what?
Figure out the note?
Yes, and that's we have an attorney do it when we're involved. Now, an escrow company will do it, but we are not happy with the notes that come out of escrow companies. All right, or out of title. And by the way, you always get title insurance too. But yes, we have an attorney draw up the docs for these seller finance loans, and that's part of our responsibility. Okay, yeah.
Do you purchase the non-performing loans from the bank?
Yeah.
And how do you handle it? I mean, they are in default. Do you sell that property?
Well, that's not why we're here, but I'll give you a quick. We buy tapes that have anywhere from 1 to 300 loans on them. They'll all be non-performing. And then we have workout specialists that try to get the note re-performing, and then, or else we help them short sale, or we do whatever we can. But usually it's to get them re-performing, and then we sell the notes to investors. And when somebody buys a re-performing note, typically they're going to get 17, 18, 20% return on them. And then we guarantee them. If something happens to the note, the seller or the buyer, the homeowner defaults, then we'll take it back during a 2-year period of time. We'll take it back and rework it, and if we can't get it reworking during that period of 2 years, we'll give them another note. So, so the next thing that we look at, this we stay pretty close to. If it's a single-family home, we'll loan up to 90% of its value. If it's a manufactured home, 80%. A mobile home, if it's on property that's owned with the mobile home, will go up to 70%. We don't loan on mobile homes if they are on rented space. And on commercial property, we'll go up to 75%. Okay. Again, the size of the market, $94 billion in real estate notes are created each year. There's $11.7 trillion in real estate notes, and they're traded very commonly. Your note when you bought your house was immediately traded by the lender that did your loan. Hardly anybody except maybe local credit unions, a few. We just got a tape in about 3 weeks ago that had 158 loans on it, and they were all owned by the original lender. That's very, very unusual. So now we want to talk about the simultaneous close, the whole exciting thing that makes all this possible, and that is the way to get cash for the seller at the closing table and to get your commission. So a simultaneous close is a transaction in which the seller of a property agrees to sell with seller financing, and the note that is created is immediately or simultaneously sold at the closing. All right? Very common. Sometimes the investor will require that it's seasoned for 1 month, that 1 month has to be paid, and then the seller gets his money. But a simultaneous close at the closing is very, very common. All right? And what we're doing with real estate agents is exactly that. By the way, when you go to a closing table, and this has happened, we go to a closing table and the lender, a conventional lender, a B of A, you sit down at the closing table and find out, oh, they've decided not to fund that note. We also tell the buyer and the seller before the sales transaction is ever done that we are buying that note. We're closing on that note at the close so that the seller knows if he accepts the offer, they're going to get financed. All right. So So we're going to do a simultaneous close. What are the options that we have or that the seller has to get rid of his note, to get cash? Well, the first thing is, that we've looked at two of them, are full sales. We buy the entire note. If it's a 360 months, we buy 360 months. If it's 180 months, if it's a 15-year note, we buy 180 months. I have to say that's not the most common one. It benefits us the most. We make the most money if we buy a full note. But the truth of the matter is, more than half are going to be partials. And a partial is simply we buy a stream of income for a number of months of that 300, let's say it's a 30-year note, 360 months. We'll buy any number of payments from that note. The important thing is, what does the seller need? What does he want in cash? What does he have to have immediately? We can tailor the partial to what kind of cash they want. For example, well, let me go through the list and then we'll show some examples. We can also do a partial sale back end, where the seller is going to keep, let's say, payments for 5 years. They're going to take the first 60 payments and then we're going to buy the next 120 or whatever. Right? We can do that at the close. We can buy that and then wait. Now, the discount on that's going to be pretty significant because all this is based upon time value of money. $1 today is worth more than $1 10 years from now. So the payments that we're going to wait 10 years to get are worth less than the payments if we got them today. So there's going to be a significant discount if we do a back end. But we can do a back end. Say that somebody, let's say that the seller's child is just starting college and he needs that stream of income to pay college tuition for a period of time, but he doesn't want to take a discount up front. He can collect those payments for 5 years and then we'll start collecting them for a period of time. That's a partial back end. Partial sale, we take a half of each payment. So if we amortize a loan over 360 months and the payment is $1,000, we take $500, the seller takes $500. We do a half a payment. There's you can create so many different things to satisfy the needs of the buyer and seller to make it extremely attractive. Let's say that, and we're going to talk about balloons in a minute, but let's say that we write a note that has a balloon in 10 years. We can buy the payments up to 10 years and let the seller keep the balloon. We can let the seller collect the payments and we can buy the balloon. We can buy the payments and let the seller keep half the balloon. You can do, as long as you can do NI, PV, PMT, and FV, you can do just about anything with these. And so it all boils down to what does it take to get the deal done? And what does the seller want and what does the buyer want? So you can really get creative. Okay, Tyler, we're going to do partials. Okay, here's a partial. This is a pretty vanilla one. Investors such as us will purchase a stream of income for a period of time, thereby making for a smaller discount. Let's say we have a sale price of $250, a down payment of $50. Seller's going to carry a first at 8% for 30 years. That's a $200,000 note. We have a monthly payment of $1,467. We would purchase the first 36 payments. At the closing table, we put down $42,922 and buy the first 36 payments. So the seller at the closing table got $92,000. He got $50,000 plus $42,000, gets $92,000 at the close, and in the 37th month, that seller gets the note back. And the note is still worth $194,560. Not a bad discount if they needed cash up front and still wanted to do a seller finance note. So we bought 36, they have 324 that they're going to collect after our 36. Okay, that's the first kind of partial. Now that 36 is an arbitrary number. We can buy 24, we can buy 48, we can buy 60. We just bought 120, a note with 120. One lady in Las Vegas had 2 properties that she had notes on. They're seasoned for 5 years. And she had a commercial property that the tenants moved out in the middle of the night and she couldn't make her payments. So she wanted to sell these 2 notes on residential properties. She sold one for 120. She sold one of 120 payments. We bought 120 payments. How many were left on that, Larry? 300 and... 240. So we bought 120. There were 240 left. So when our 121st month from today, she gets the loan back for another 120 months of $1,100 or $1,062 a month. She sold us another note that was, she sold the entire note that was aged about the same, had an $1,162 payment, and had about the same amount of time left on it, and we bought that note from her too. So partials are a big part of this business. So let's go to the next one, Tyler. This is the amortization schedule of that note we just talked about. You can see the loan amount is $200,000, or maybe you can't in the back of the room. 8% interest, loan 30 years, 12 payments a year, starting on February 1st, 2013. A $1,467.53 a month payment, and you can see we took a big gap out of this so we could go from 1 month and show you the 36th month. At the end of the 36th month, there's still a balance on that note of $194,729. So the seller has lost less than $6,000 worth of the value of the note by collecting $42,000 at the initiation of the note. All right, powerful things when you get the partials. Let's go to the next one, Tyler. This one here is we're going to purchase 1/2 of the payment each month. So again, the sale price, same thing. Sale price of $250, down payment of $50, owner carryback first at 8%, it's $200. The monthly payment $1,467. We buy 1/2 of each payment for $733.50. So we're going to buy 360 payments of $733.50, and we're going to pay $121,309 at the close for that stream of payments. So the seller gets $171,309 at the close. Everybody follow that? And receives $733.50 per month for 30 years. It is a good deal. That got you excited, didn't it?
It actually did, because I'm looking at this, thinking about a lot of people who are in their 50s own 1 to 2 rental properties, maybe outright. But to take that money when they're still earners at a 50% tax rate, it's not good. But if they can wait until they're 65 and they have their retirement income and they move into a different tax bracket, that's a whole other bundle of money that they get, right?
Absolutely.
Oh yeah, that's beautiful.
Yeah, this is, and that's the thing, is that you decide. You decide. You decide how to do it. That's the nice thing, is that when we do anything with trust deed investing, we are flexible. The bank is not. We can do things the bank either will not or cannot do. Everything we do has to be for the benefit of the buyer and seller. When the Bank of America does a loan, it's for the benefit of Bank of America, not for the lender and not for the home seller. So, yeah.
Say hypothetically, that's kind of a hefty interest rate, especially right now for potential buyers. But say after 5 years, they cleaned up their credit and they're ready to get some conventional financing at a lower interest rate, do you set these up with prepayment penalties or not?
Rarely do we do that, but we might. There's so many things you can do. I'll give you an example. I told you about the woman, we just bought the house or the note in Las Vegas. We paid $94,000 for a note. The house is worth $150,000. The balance of the note was $139,000, I think.
Yeah, $136,000.
Okay, people have paid on it for 5 years. The interest rate is 9%. What would you do if you owned that note? I'm going to bust my butt to find them refinancing and get them refinanced at 5%. Why? Because I'm going to give them a discount. They owe me $139,000. I'm going to tell them, if you get this refinanced in 30 days, I'm going to finance it for $120,000. I'm going to give you a $20,000 discount if you will get it refinanced in 30 days. Why would I do that? Because I'm going to make $26,000 in 30 days on a $94,000 investment. What kind of return is that? Annualized.
Taxable.
Taxable, that's
Well,
right.
the way the interest rate goes, if they took that out for 30 years, the last 15 years, you're really not making money. I mean, because they pay all their interest rate up at the beginning, so if they refinance in 5 years, that's gold, right?
Oh, yeah, and their payment dropped to like $450 a month. So, you know, if you work with a mortgage brokers, you can get these people refinanced and you can't do that if you're the seller that's financing it, because you don't have a discount to work with, but we have a discount. That's why we're in the business. But anyway, this one here is a great way to do it, as well as got one that we call fast cash, where we'll buy 10% of the payments for 10% of the note. Do it immediately. 10%, let's say it's a 360-month note for $100,000. We'll buy 10% of the payments, 36 payments, for 10% of the note, $10,000. All right, so that's another partial. What do we got, Ty? Yeah.
So what if you are the seller?
I'm the seller of what?
And I seller financed a home and
Okay.
About 9% interest, and 5 years down the road, the buyer can get a different loan.
Okay.
Are they putting in prepayment penalties?
No, because let's look at it from you, the seller, the homeowner, the seller of the property's investment intelligence. If you, let's say that at the end of 5 years, they still owed you $100,000 cash. At the end of 5 years, they've reduced the principal very small. But so let's say they owe you $99,000. Would you rather wait another 25 years to get $99,000 at 9%, or would you rather get, let's say, $85,000 today? You might want to make a decision. I'd rather get $85,000 today. So if I help you get refinanced, and you've kept good records as the people collecting the payment, you might be able to get them financed for $85,000, so their payment goes down considerably, and you get your $85,000 cash today. If you would prefer to have that $99,000 earning you 9% for the next 25 years, that's a decision you would have to make. But we would not put seller finance or a prepayment penalty in ours.
So as a seller, being a seller financing, would you just kind of build in and make it a 5-year plan with payment in 5 years?
I don't like balloon payments, and there are legal reasons for not liking balloon payments. Now, we write balloon payments because sometimes they're just absolutely necessary. But the problem is that if let's say you do a balloon payment, and your analysis of the home buyer, of the buyer, the borrower, is that they can pay this amount. what makes you believe that they're going to be able to afford to pay you the balloon payment in 5, 7, 10 years, whatever you make it, or that they are going to be able to get, if they can't get refinanced today, you're making an assumption that they can get refinanced in 10 years from now. You're opening yourself up for some, some problems. And one of the problems is, I think Tyler will probably talk about, is when they declare bankruptcy and they have a balloon payment that they couldn't make. I would prefer to do stepped payments. Is anybody familiar with stepped payments in here? Okay. When you analyze the homeowner's ability to pay, you make a decision at that point. Could they reasonably pay another $30 a month next year, and then another $30 a month the following year, and another $30 a month the following year? And you put up an amortization schedule based upon payments like that. So in the case that we did just before that, we had a payment of $733.76 a month. So if we put a balloon on that, they have to come up with $87,841 in 10 years. Why do I believe that they're going to be able to do that? And how am I going to convince a judge, more importantly, that I did my due diligence. I really am doing these guys a favor by giving them a balloon of $87,000. Or what makes me believe that they can get $87,000 worth of financing? Yeah.
Well, what makes me believe it is they're paying above par on interest rates. So if, like now, the current interest rates, if they can get a loan, if they could, they had great credit, could get 4%, and you're charging them 8%, that's going to be an impetus for them to find a loan.
Well, I'm not saying they don't want to. I'm saying they can't. What makes me believe they can, that if they say I took advantage of them. All right, I don't want that to happen.
Which they're very sensitive about.
Right, exactly right. That's why this is there. We got more requirements and more requirements every day. Attorneys, I'm telling you. So,
We all need our own person.
so what do? We take a look at step payments. So let's take a look at a step payment. So we got the same face amount of $100,000. They only carry back same note, $733.76 a month. We're going to have step payments of $30 a month. Every year after the first year, the payment's going to go up by $30 a month. So the second year's payment $763, the third year's payment $793, and so on and so on. So if we did it like this, the house would be paid off in 16 years. What if we could do $50 a month increase per month every year? Or we could do 70, 60, you know, if we talk to the borrower and find out what makes it beneficial to them. And what if it was only 30? Well, at the end of 10 years, the balloon payment, because we've done this, and all that extra $30 a month is principal payment, at the end, and plus additional interest that they're paying, is now reducing the principal because their interest due is not as much. At the end of the 10 years, their balloon payment may be $50,000. All right, so take a look at step payments. Now, the only problem with step payments is they're a little difficult to calculate an amortization schedule. There is a software called T-Value. Is anybody familiar with T-Value? It's tvalue.com. Tyler, go to the next slide if you would. This is a calculation done by T-Value. If you don't do a lot of this stuff, it's probably price prohibitive. It's like $500 to buy. But it does T-values for you. And this is the amortization schedule that it spits out with the increase there of $30 a month. And we've, again, squeezed out a lot of the middle to give us loan 1, 2, and then the 194th month, 195th, 196th, it pays off. So that's one way to avoid balloons, and it's a very attractive way to avoid any problems down the road. So this is language. Now everybody's getting a copy of this PowerPoint. This is what you would put into the note. 1 year after the close of escrow and annually thereafter until the note's paid in full, the amount of the monthly installment shall be increased $30 per month above the amount paid during the prior year. Or you can do it as a percentage, like we're going to increase your payment 2% per month every year subsequent to the first year. You would put the percentage in instead. Or you would contact your attorney and have them write up the note language like so, okay? Now, the last thing I want to talk about is servicers. In our business, they're very, very important. We probably could not service a loan for $15 or $17. We use a company in Southern California called FCI. They're in Irvine. They charge us $15 a loan. They do all the billing. They send out the payment stubs or the payment books. They collect the money. If it's an escrow account, they pay the taxes. They pay the insurance. They send us our share, whatever's left over, after they take their $15 out. If you're going to get into the business of selling notes, you really need to have a third party, an arm's length transaction between somebody that's keeping your payment records and you. Because the next slide will show you what happens. This is a note from a guy in San Bernardino, California. He wants to sell his note to us. I said, send us the payment record, and this is what we got. So I guess I ask you, how do we value that note? It's very difficult, because now when we get something like this, we'll send them an affidavit to record the payments, and then they get that notarized and they're swearing that that's the payments. But what if it isn't? Now we have to go through the whole hassle of suing them or getting them whatever. So you don't get this from a servicer. Go to the next one. This is what you get from a servicer. The fact that it's done like this is a big benefit, but more importantly, when I send this to the investor that might be wanting to buy this note, they see, number one, it didn't come from us. It came from somebody else who does this for a living, and this is the record this is an honest record of what was done. In addition to that, they send out the 1098 at the end of the year to the homeowner for their taxes.
Good for your tax records, too.
Oh, absolutely, yeah. Okay, I'm done. Tyler's going to get up here and cover some legal stuff. Yeah.
With the interest rates the way they are right now, where do you gauge your interest rates in the future when it's 5% and 7% by the mainstream?
Well, we're going to have to be conscious of usury laws, but it's not uncommon to see back when the interest rates were higher, it would not be uncommon to see a 12% rate. So, they could go to that again, whatever. Yeah.
Is there anything like a landlord who has a bunch of properties that they're looking to sell off or sell the properties to a homeowner and carry the paper back? Is there anything that they have to be careful of as far as usury or legal consequences or anything like that? No.
I can answer that for you.
Yeah, let Tyler answer that, all right? Yeah.
Sorry. So let's say I go on a listing appointment, somebody's thinking about selling it, and it's really not a good fit, and we start discussing about what their needs are. Sometimes they'll mention that they're not ready for a 1031 exchange, they can't take the burden of the tax consequence, and we suggest, hey, you might sell your note. I'd like to know how I still make my 3%.
All right, that's a good question.
That's a fair question from an agent.
No, that's why we're here. To get that's right. If you can't get any commission, why bother doing it? But here's how you get your commission. All right. Absolutely. Well, you're finding the buyer. And more importantly, you found me. That's going to help you put this together.
Okay.
All right, so what we do is you sit down with him and you say, okay, what kind of cash do you need? Let's go over this. How much is it? What are going to be closing costs on this transaction? Closing costs are going to include your commission and the other commission. Let's say there's a 5% commission. The house is $200,000. You got $10,000 worth of real estate commissions. You got to have enough cash coming in at the close to pay those closing costs, right? What else do you need, Mr. Homeowner, seller, is in the way of cash?
Okay, so let's say we get there and they're not, for whatever reason, there's a renter in it, they're kind of done being a landlord. We know that we've got a good rental history. To sell it would be kind of a pain. We've got to get rid of the renter. It's possibly an investor. And let's just say they want to, I don't know, how can I say this? So they own the house free and clear, almost like a reverse mortgage. And they
Okay,
decide,
all right.
maybe
So
I'll just sell my interest in this to, you know, maybe the renter wants to buy it or something. We don't have someone else.
They don't want to do that.
Okay.
They get out of the rental business entirely. So then you find a buyer to buy their rental properties, and, you know, being what the market is right now as far as down payments for buyers and qualifying on rental properties, and if they own it outright, it's to their advantage to carry the paper, or take part of it and then
so
go
let's
to
say
them
that they
and
do that and they call me 3 years from now. And they're like, you know what, I need some money, I want to sell the note, Kate. Can you
Great.
help me? How do I make my commission then? Again.
you make a deal with me
Okay.
at that point. We say, okay, here's what we're going to do. We're going to buy the note. He calls you, let's say 5 years from now. He's still carrying this note, and he says, hey, I need some cash. And we say, how about if we buy 60 months? I mean, is that satisfactory? You sell 60 months for this amount of money. He says, yes. What's your name?
Katie.
Katie? All right, Katie, how about, what are you and I going to do? I'm going to come up with the cash to pay this note. What do you want for a commission to bring the deal to us? A finder's fee or whatever. We can do that. So it probably at that time would be our responsibility to take care of you. All right, and we would be more than happy to do that.
Sorry, we don't get paid in smiles as realtors. We gotta.
Hey, I've been there. I know exactly, and you're the first one at the closing table that they say, hey, can you take a hit on this? So, yeah.
Are you your company looking for investors?
Is Brian here? Yes. Yes. I have to be careful in how I present ourselves because of security laws, not because of the board, but because of security laws. I can't ask you to invest, but we are looking for investors. If anybody is interested, then we need to speak one-on-one. All right, and I get very close consultation from my attorneys. They don't want to visit me in jail. They wouldn't visit me in jail. So yes, we are constantly looking for investors. As a matter of fact, how many? There's 20 people in this room?
25.
Well, not counting us because we're counted already, but we're having a kind of a get-together Tuesday night at Northridge Country Club from 5:30 to 7:30. If you promise not to eat too much or drink too much, no, seriously, I would like to invite you to come. If you're at all interested in investing in trust deeds, it's not going to be a sales pitch. We're going to have a 15-minute presentation on what we do. It's mostly friends, family of us and my kids and people we've known for 30 years. Tuesday night, the 29th at 5:30. Pardon me?
Yeah, send us an invite. If I get your email address, I can send an invite out.
And if you would, please RSVP if you are coming so we know head count for food. Okay. Yeah.
And this isn't for your company in general, because I know that you can't do that, but if somebody has an IRA that they want to self-direct, awesome.
In fact, I asked the company that we use to send me some brochures. Now, there's a number of companies that you can use for self-directed IRAs. I would say that more than half of our investors are using their IRAs. And the company that I use is etctrust.com, etctrust, huh? Or trustetc.com. trustetc.com. They've been very, very good people to work with, very quick. You might want to contact them to get a self-directed IRA set up. So, I will say this, if you don't come Tuesday night, I just want to say this. What we do is very transparent. And because of all the scams and stiff that people have gotten over the last 10 years with Bernie Madoff and the guy over in Folsom, and you know, from my hometown, I'm from Iowa originally, there was a guy there that just took $200 million from people in Iowa. We are very transparent. Everything you do with us, you're on a trust deed. If you want to find out where it is, you go look in the county recorder's office. It's there. You're not giving us money. Everything we do is through an escrow company, so the money doesn't come directly to us. So all we can say is that what we do provides a very, very good return, and it's very transparent. So, and we have an office. We're in Fair Oaks. Very easy to come and see. Yeah, Rico.
Would you mind going through a sample? I have like an actual potential seller that I want to approach, because I think they'll benefit everyone here. Would you mind going through this?
Yeah, what do you want me to be?
Just exactly the way we are right now. I have the seller. I have a property's worth around 135. She owes 77,000, but she wants to sell it for a little bit more, just so she can. But you know, no one's gonna try to buy it for more than
He's not a buyer, right? You
No.
have a buyer?
No, I'm gonna try to find a buyer.
Okay.
I wanna approach
How about
the
if
seller.
I'm you and you're the homeowner? Okay, you're
I
the
was gonna
person.
have you write it down in
Yeah,
how
I
you
will.
to
I will.
approach
But
it.
you're the homeowner. I'm talking to you. I'm trying to get you to tell me what you want and what you need, and then we're going to design a program to fit that. Okay? Okay, Rico. I've looked at your house here. I think we can comfortably sell it for $130. Is that what you told me? We can comfortably sell it for $135. You have a $77,000.
And I just want to sell it for, hopefully over that to cover.
Why not sell it for $135?
I'd like to have as much as I can, just so I can use the money to buy it.
Okay, well, I'm trying to, last thing I'd do is, if I were the homeowners, to say, I have a house worth $135 and I'm going to sell it to you for $77, I'd probably say, I'll give you a deal and sell it to you for $131, you know. But you want to do the best thing you can for your client, all right? So why would we not be able to get $135?
You want to sell it for more than 135, right?
Yeah.
It's worth 135.
Oh, I thought you said she wanted more than, well, okay.
To get more,
Then 135?
yeah.
Well, then I probably would not be very involved in that, because we don't want to take advantage of a buyer who's going to buy this because of seller finance and then charge more than the house is worth.
Well, let's just say I want to approach her to let her know that if we sell at 135, here's what we can do, and I want to talk to you in terms of how should I approach
Okay,
it.
so,
Sound,
all right, what kind of house is it? What's it? Is it
3 bedrooms.
is it in decent shape?
Yeah.
All right.
Just,
Is she an owner? She's in it?
no, it's an investment.
It's an investment. All right. Well, here's what I'd tell her. You know, are you willing to carry some seller financing? Can I show you how you can benefit by carrying some seller financing? You said sure. All right. So then I would say, well, let me paint you a scenario of how this could look. Let's say that I can get somebody that would give me, it's a non-owner occupied, I'd probably want 15% down from an investor. All right. So $135. 114, 750. Can we say 114, 750? All right, that's what we're going to have to write a note for, $114,750. She's going to get $13,500 at the close. Cash. All right. Now we can do one of a number of things. One, we can figure out this entire note. Chrissy, you got your calculator ready that you could give me? Let's say that we do a 360-month payment at 9%. What the payment is on that?
For 135?
No, 114,750.
Did you say 15%?
Yeah. Oh, that's right. Never mind. Okay, to make it easy, we're going to take 10% down. We would not take 10% down. We would not take 10% down on an investor type property. Sorry, thanks, Larry. That's why you're pricing and I'm not. Are you doing the payments for me, or did you get the payments?
I thought you went on to something.
Okay, never mind.
That's 360, 9%.
That's the problem when you work with your kids. No respect. And when we get out of here, she's going to blame it on me. She's going to say it was my fault.
977, $121,000 note, $977.
All right, 121, and it's 977 a month. All right, so now we know that this is going to amortize for 30 years for $977 a month. We can make a decision now. What are we going to do for the homeowner? The payment, do you know what the payment is on this $77,000? How long has she been there?
She's had it for a year.
Oh, just a year? Do you know what she bought it for?
95.
Why is it worth $135 now?
I just did comps.
And you really think it is? It went up that much, okay? At that end, yeah, all right.
0.7.
Okay, well, I have to assume that all these numbers are right. I'm going to assume that 135 is a good price. We got $977. Do a $77,360 for.
She fixed it up too.
Okay, good. All right, so 65, and this is really good for flippers and people that fix up to be able to sell or finance, get and sell the note. To be able to turn the house quickly, if they can sell or finance and sell the note, they can move on to their other one. Okay, so what's the 77,000?
At 5%, it's 413.
413. All right, so let's say her payment is 413. All right, so there's a $564 a month cash flow if all we did was buy that house and gave her $13,500, wrapped the note for $121,000, which included the 77. The buyer pays us $977. We pay the lender $413, and we pocket $564. That's the simplest way. All right? What if we wanted to buy a partial here? Let's say we want to buy 50 months. Now, let's say now you're going to get an investor involved because we're going to get her money. So we're going to get an investor involved. I can buy this whole thing, $564 a month for one thing that we're going to have to do, I don't know the particulars of this note, but we're going to have to make our note run the same amount of time as this note is left. If this note has 350 months left on it, then my note has to be for 350 months, because I don't want any balance left over in payments at the end of when this one's paid off.
Let's do that then, let's go 350.
Well, it's just going to be a mathematical. Okay, we'll do 350. All right. So $564. Let's do this.
Does your wrap have to be 350 then too?
Yeah, that's what I'm saying. We have to make that exactly the same. So she's got 350 months left to pay, and so I'm going to buy. That was $564, right? Per month for 350 months. So I'm going to buy that, and I want a 12% return. I want a 12% yield. So let's do a $564 payment for 354 months. You guys want to use the, let's write it down. Interest, present value, payment, and future value. Number, 350. Interest, 12%. I want 12%. Present value, that's what we're going to solve for. Payment, $564. Future value is 0 because we're not putting a balloon on this. We're amortizing it all the way out 350 months. All right? Anybody got a calculator to stick that in, or you want me to do that? 54,000. 667. That won't work because we got $77,000 balance on it. So what am I going to do? I'm probably going to buy a partial. So what I would do, yeah.
Isn't this 564 only the difference between what we're getting paid?
Oh yeah, I'm sorry. We got to pay. This is what we'd pay for the difference. We got $977 payment here. So what I'm going to have to do is buy a partial. Probably the most that we could probably buy on this wrap would be probably 60 months, 5 years, and then she gets it back. But the nice thing about doing a partial and doing it for 5 years and then giving it back is at the end of that time, we can buy another 5 years.
Okay, so how much does she get? She gets the original 10%.
She gets $13,500. And she gets, well, hold on a second here.
564 times 60?
No. We got to figure out, here, let me do this. 564 payment.
Yeah, that's 94,000.
Yeah, that's way too out of sight. So we're going to take, we got to take that 77,000 balance over out of what we're going to be paying her, because we can't give her $54,000 today, because now we're at the exact value of the house. We got $54,000 that we're giving her, plus the 77,000. We're at 135,000. So we're going to have to do a partial. Because what would happen if what we want to consider here is what would happen if this thing foreclosed? All right? What if we had to foreclose on it? Well, we're encumbered 100%. We're going to lose money if we have to foreclose on it. So we want our income, we want our loan to value to be less than 80%.
Okay.
All right, 70%.
You want to go 60 months. I just want to see how I get paid, first of all, and then how much it's going to walk.
Well, you're getting paid already because she got $13,500 down, and your commission is what, $7,000 on this, or? Okay, she got $13,500 down. That's going to cover her payment to you. So now she can either get $977 a month and pay out $417 and net $564, or she can sell the note.
She's really not going to get 10% down. She's going to get 10% minus our commissions.
Well, yeah. I mean, she's got $13,500 in cash to pay your commissions with and closing costs. All right. Now, any other monies that she wants up front at the closing, she's going to have to do in selling the note. We can't pay a typical note because the balance is too high.
Okay, now, so you said you were going to do a partial?
Yeah, I'd do a partial.
So that should we get that at closing?
Yes, she would get that at closing, and then we would collect this money for 5 years, $977 a month, pay out $413, net $564 for 5 years, and then she would get the note back. After on the 61st month, she would get the note back.
So just 564 times 60 is how much additional?
Well, that's 30 grand, isn't it? 564. Well, wait a minute. 564 times 60 is 33,840. And we want to make 12%. So we're going to deduct 12% from that annualized 12% return, and so we're going to pay her probably 20 grand for that money. All right, so she gets 33.5 up front. All of her costs come out of that, and she gets the note back in the 61st month. And we could do an amortization schedule and see what that balance was. The balance is 121 minus 77. That's the balance of the note that she's going to get back, because she's still got to pay the $77,000. That's probably the only way that it would be able to be done with such a high balance on the first.
Would it be a benefit to her to do that?
If she's willing to take $33,000 cash right now.
Yeah, maybe just purchase one property instead of two. So.
Yeah, it really depends on whether or not it's a non-owner occupied house. She's going to get hit with a capital gains tax in California and federal. If she sells it for $135 and she's got $77 in it, she's got a capital gain tax of $60,000, close to. That's going to cost her 20 grand probably now. So is she willing to walk away with $40,000 or $33,000 and get a note back in 5 years? Well, I know what I'd do. I'd sell the note. Everybody see that? I mean, you got to figure out her after tax.
After the 5 years?
Pardon me?
Sell the note after the 5 years?
No, I would sell it now. Come up with $33,500 today. Sell the note for 5 years, and at the end of 5 years, get it back. The reason being is that I'm going to have to pay $40,000 or $20,000 of my $60,000 profit in taxes. I'm left with 40 versus being left with 33 and getting a note back in 5 years. Depends on how strained she is for cash. But we loaned, yeah, all right. We got to get Tyler up here. I'd be happy to stay, and I know Tyler will, for as long as you want to ask questions, but let's get him up here and finish up, and you can boo attorneys if you want, but we got his mother will.
Thank you for doing that.
You're welcome. And if you get in a situation, just call me on the phone, and we can work something on the phone, you know, the numbers, all right?
We're probably under RESPA because of the amount of transactions that Main Street does, but a general broker might not be. That doesn't mean that I'm not going to give a HUD-1 statement as a seller, you know, as a seller who's financing. HUD-1, the good faith estimate, pretty much, Yeah. Anything that you can disclose, you disclose. Why? Because you don't want it to come back to you. It's even if you've done everything according to the law, if there's a buyer that is expecting certain disclosures that aren't made, they're going to be upset. So we just disclose, disclose, disclose. It helps for happy buyers, happy sellers, and happy us. I'm an attorney, but I don't like going to court, even if it's for my dad. So
That never happens.
it's not a fun place to be in any event, and so we just try to disclose as much as possible. There are a couple other things in California. That's this 300 form, right? You have to get certain, like they're passing a whole bunch of new laws, and some of them that just got passed January 1st. I'm not exactly sure how they're going to impact part of our business, but for this, the deal is, if you're selling a note, or if the seller is selling one of the notes that they've created, they have to sell it to somebody who's qualified to buy it. That's what that investor questionnaire that we just passed out to you is. And what's that?
Can they afford to lose it?
Right. Can they afford to lose it? Now, again, we talked about property values not going down to zero, but they still have the potential to lose. And California also requires a carryback disclosure statement, and that's another form that basically provides the terms. Note, however, that when we're talking about the terms that are disclosed in the seller carryback statement, they're also going to be disclosed in your HUD-1, in your truth in lending, in your good faith estimate, those types of things. So if we're maintaining the highest level of protection, then it's going to encompass everything else underneath it, and that's what we really try to do. Yeah?
What changes has the SAFE Act from a couple of years ago made to all the seller financing?
You know, it's changed things to the effect that it's made notes a little bit more or less, or maybe a little bit less marketable, I think. You know, from our perspective, we're not going to, a lender who's only doing, or a seller who's only doing business in California, who's only selling a couple houses per year. Look, we have to keep in mind that we as real estate professionals aren't the ones that are actually owning the property and buying the property, right? We're just facilitators. So most of the people that are going to be involved in a seller finance like this are not going to be doing high volume. They're not going to fall under the purview of federally related lenders. SAFE Act covers federally related lenders. So it's a matter of,
Whenever you are a realtor and you are an investor and you're actively buying and selling.
You know, it'd probably be how the SAFE Act itself is something that I'm not exactly sure how that itself has affected everything. What I'm looking at right now is how the general context and how the legal environment is for it all over the place. The SAFE Act is just one part of the regulations that we have to deal with. And that's like, you know, what I'm trying to say is if we're satisfying the highest level, what is required by the highest authorities out there, then we're going to be safe when we're doing things that don't even need that, right? We're disclosing more than is required.
Some of the rumor, when it was talked about when that first was getting publicized, but it was going to squash owner financing.
Well, that got defeated, though. There were so many people that got a hold of Congress, and it would have impacted owner financing a great deal. What it's done now is, if the owner does less than 5 a year, then that person's not even addressed under Dodd-Frank. However, I am, as a broker, I am a note broker, I am a mortgage broker, but I don't do mortgage. I don't write mortgages, but we do mortgage broker for private lending. There are enforcements on my license and my job that I have to do, and one of them is to be sure that if I'm not dealing with an accredited investor, which is, if everybody knows what accredited investor is, if the person is not an accredited investor, the disclosures I've got to make are numerous and required. That's the biggest impact of Dodd-Frank. There is no limitation on how many I can do, but if you do more than 5 as a seller, let's say you're an investor and you do your own financing on more than 5 deals, you would now have to perform under Dodd-Frank or the SAFE Act. And,
5 for
and,
you.
Yeah, 5.
So are you a securities broker? Are you under SEC?
I'm not a broker.
Although he's written private offerings for us.
Yeah, the securities part of things, I don't need any license to do securities law, but I'm not a broker of any
But
sort.
I mean, the part of the company that trades notes in the secondary market, is that's you?
Yeah.
So is that, are
And
you
Prissy.
under,
There are no SEC licenses required. There's no SEC license to have this note. See, one of the things that we want to think about is, yes, a note, any debt instrument is a security, right? Mortgages have this interesting little carve-out that allows them to be traded differently, that allows people to originate them without SEC regulations, which allows a seller to put one together and then sell it to an individual person. What we're not doing is pooling. You know, they don't do any of the pooling or anything like that. These aren't mortgage-backed securities. They're mortgages. So it takes it outside of the realm of the SEC. It's basically a private transaction, right? The thing that you do keep in mind is when selling a note, whether or not the end buyer can afford it, can afford to lose it, can afford anything like that. And for the most part, when we're talking about purchasing and selling notes, dealing a lot with accredited investors is what ends up happening, just because it's far easier. But again, there are kind of some changes in the law that are supposed to go into effect that might change that too, so we'll see. Any other questions from anybody? If you have any that you'd like to talk one-on-one, I'd be happy to answer them, and thank you guys very much.
I mentioned just 2 things before you go. It's kind of caught my ear. First, I want to go through a transaction that we just tried to do last week, because this is where you would get in trouble with Dodd-Frank or the SAFE Act if you didn't know what you were doing. We had a tab on a house. The house it was in St. George, Utah. The people lived in Idaho. And we agreed to loan the money to buy and fix up the house. As it turned out, the collateral on the house they were buying, we couldn't get at the time we funded the note, because it was somebody that bought in bulk REOs from Fannie Mae, and there's a 90-day restriction, although the people that bought it wanted their money today. So what happened was that we can't collateralize that house that we're buying. We had to collateralize their private residence. Now we're in a whole new different ballgame than loaning to a investor on a non-owner occupied house. Now we're loaning to a homeowner, and now we have all of the regulations required, because now we're a mortgage lender. And avoid that. If you can, avoid that at all costs. That's where Dodd-Frank will nip people that aren't aware of what happened, and we had no intention of ever getting involved, but it evolved that way, and it was one that if you weren't aware of what you were doing, you're just going to collateralize a house, you've just violated the law. So.
Is that investor to investor, like if investors are loaning each other money to rehab houses?
Well, if you loaned it on their primary residence,
okay.
Yeah, then you better think about complying. Okay. Thank you guys all for coming.
Thank you.